Well, Mathieu Chabran, co-founder of TKO Capital, is still with us, and he believes the growth in private credit and alternatives is going to continue. So, Matthew, this is an interesting point of discussion because, on the other hand, we have UBS predicting a 15% default rate in private credit. What's your assessment of private credit default risk?
Yeah, well, it's a very interesting discussion you're opening up, Paul, here, because Boaz and Saba's comment, over the past few weeks are always interesting in this type of market environment. Default, well, I'm a leveraged finance banker by background. That's where, I started in the late 90s, and I remember in my early years of learning, the job of underwriting credit risks. It was effectively about financing cash flow, making sure that you had, some collateral and some assets, making sure you had some covenants, in your documentation so that you could effectively work on a restructuring when and if need be. And it seems, which is certainly what has triggered this whole situation over the past few weeks, that maybe the private market, part of the credit market, had become complacent in the credit risk underwriting. So no surprise that default, would go up, in that respect. But if we put things into perspective, Paul, it's now March 2026. We're 5-6 years after the COVID situation, where, if you remember, interest rates were at zero, if not negative in some part of the world. Credit spreads were highly accommodating because we had the central banks all over the world, telling the market that they would be, buying some credit. And we created massive stocks of debt, corporate debt, but not only, that are now, coming due for maturity and hence, repayment. Because if we come back to basics, a credit is a nominal, a maturity, and a coupon, right? So, based on these three key features of credit, if your underwriting standard and your discipline is right, you will always navigate through cycles and have some default, but you should mitigate what some people are now effectively forecasting as some, very high, default rate. By the way, I'm not buying at all, the UBS case, that they came up with. The one thing people have to keep an eye on is certainly what has happened, in the U.S. market. And I think that Boaz, was referring certainly to the U.S. market, which have been the biggest beneficiaries of all the flows that have been raised over the past, 5-7 years in the private market, which in turn, have floated a market that had no shortage of capital, because the U.S. is a market where you've got the banks, you've got the regional banks, you've got the BDCs, you've got the capital market, and now you've got the asset managers. And what is very interesting is effectively to look at where are these defaults coming from. We're talking about the rating agencies. I think it's a Fitch report that came out. We're now at 9% default in the mid-market U.S. direct lending, which is triggering effectively this sell-off. But in other parts of the world, and specifically here in Asia, in Australia, that you will be very familiar with, and in Europe, the credit quality had not deteriorated as fast as or as badly as it had, in the U.S. And in that context, this is where I see big opportunities.
Well, Matthew, you mentioned earlier you're New York-based. You conduct a lot of your business in Europe, but you're here in Asia at the moment. What opportunities are you looking at in private credit?
Yeah, so the obvious one right now, is effectively the private credit secondary. So, the situation where some managers, like us, will offer some liquidity to some LPs, some asset owners, for them to rebalance, reduce, dispose of their commitment into other managers. Because what we've heard so far in the market was effectively all this evergreen, semi-liquid fund, some structure that should have dealt naturally with the liquidity, and because there was, back to the basic supply-demand, Paul, there were more demand for redemption than what, the funds could offer. That created these gates. The public BDCs should be, taken care of themselves. Effectively, that's a stock price that is adjusted at the end of the day on the supply demand. But when it comes to the drawdown fund, which make up the bulk of the private credit, and that's why, I think it's really important, and thanks for the opportunity that people can understand that the bulk of the private markets are still wrapped into some drawdown credit, a fund, that has a maturity and where the LPs know that there is no liquidity provision until this maturity. Nonetheless, as it happened, with private equity over the past 20 years, that's a great opportunity for people who actually want out to find some people like us to effectively provide this liquidity. Because here, Paul, you're becoming a price setter. You buy that at a discount to the NAV, and you can generate the incremental premium that one would expect, for the underlying risks and for the underlying, liquidity. So that's certainly, the one of the key opportunity right now, both in Europe and Asia.
Okay. Mathieu, we are out of time, but thanks so much for joining us. That is Mathieu Chabran, co-founder of TKO Capital.